In the vast universe of technical analysis, chart patterns provide a roadmap to potential price movements. They are visual representations of trader psychology, condensed into recognizable shapes. Among the most reliable and frequently occurring of these are the flag patterns. A flag pattern is a continuation pattern. This means it signals that a prevailing trend is likely to resume after a brief pause. Think of it as a rest stop on a highway. A car traveling at high speed pulls over for a short break before continuing its journey in the same direction. The flag pattern signifies just that, a temporary consolidation in price before the primary trend reasserts itself with renewed vigor. Its reliability makes it a favorite among both novice and experienced traders. The power of the flag pattern lies in its simplicity and its clear structure. It consists of two primary components, the flagpole and the flag itself. The flagpole represents a sharp, near-vertical price move, either upward or downward. This initial burst of momentum is what establishes the trend. Following this aggressive move, the price enters a period of consolidation, forming the flag. This consolidation phase typically takes the shape of a small sloping rectangle or parallelogram, drifting against the direction of the initial trend. This visual structure gives the pattern its name, as it resembles a flag on a pole. Understanding these basic features is the first step toward mastering this powerful trading tool. Spotting a flag pattern on a price chart requires a trained eye, but the rules are straightforward. You are looking for a strong, directional move, followed by a period of quiet, orderly consolidation. The pattern indicates that the market is taking a breath. The initial participants who drove the price up or down are taking some profits, while new participants are waiting for a clear signal to enter. This temporary equilibrium creates the flag. Once the consolidation phase ends, the price breaks out of the flag formation, typically with a surge of volume, and continues its original journey. The pattern is considered complete only after this breakout occurs, confirming the continuation of the trend. The significance of the flag pattern cannot be overstated for traders who focus on trends. It provides a low-risk entry point into an established move. Instead of chasing a fast-moving price, a trader can wait for the flag to form and enter the market just as the trend is about to resume. This method offers a more favorable risk-to-reward ratio. The stop loss can be placed tightly, just outside the flag consolidation, while the potential profit target is often measured by the length of the initial flagpole. In the following sections, we will dissect this pattern piece by piece, exploring its types, the psychology behind it, and a step-by-step guide to trading it effectively. The first and most crucial component of any flag pattern is the flagpole. The flagpole is not just any price move. It is a sharp, significant, and rapid advance or decline in price. This move should occur on high or expanding volume, signifying strong conviction from market participants. A weak, gradual, or choppy move does not qualify as a proper flagpole. Think of it as the initial announcement of a powerful new trend or the strong continuation of an existing one. The length of the flagpole is also important, as it is often used to project the potential price target after the breakout. A long and steep flagpole suggests that the underlying momentum is substantial, hinting at a powerful continuation move. Following the formation of the flagpole, the market enters the consolidation phase, which creates the flag itself. This phase is characterized by a period of lower volatility and decreased trading volume. The price action during this time forms a small, compact rectangular or parallelogram shape that slopes gently against the primary trend. For instance, in a bullish flag which follows a sharp move up, the flag will slope downward. Conversely, in a bearish flag which follows a sharp move down, the flag will slope upward. This counter-trend drift is a critical feature. It represents a brief period of profit-taking and indecision, not a reversal of the underlying trend. The boundaries of the flag are formed by two parallel trend lines. The upper trend line connects the swing highs of the consolidation period, while the lower trend line connects the swing lows. These lines should be roughly parallel, giving the pattern its classic rectangular appearance. The duration of the flag is also a key consideration. A flag pattern is a short-term consolidation. It typically lasts from a few days to a few weeks on a daily chart. If the consolidation period drags on for too long, the pattern loses its predictive power. The momentum from the flagpole can dissipate, and the pattern may fail or morph into a different formation, such as a trading range. The final piece of the puzzle is the breakout or breakdown. A breakout occurs when the price closes decisively above the upper trend line of a bullish flag. A breakdown happens when the price closes firmly below the lower trend line of a bearish flag. This move should ideally be accompanied by a significant increase in volume, confirming that the trend is resuming. This volume surge indicates that new buyers in a bull flag or sellers in a bear flag have entered the market with conviction, overwhelming the participants who were causing the consolidation. The breakout is the trader's signal to execute the trade and participate in the next leg of the trend. The bullish flag is a powerful signal that an uptrend is likely to continue. It appears after a strong upward price move, the flagpole. This initial rally is often driven by positive news, a strong earnings report, or a general shift in market sentiment. Following this explosive move, the price consolidates. This consolidation forms a small rectangular pattern that slopes downward against the prevailing uptrend. This downward drift is healthy. It shows that some early buyers are taking profits, but there are not enough sellers to reverse the trend. The volume typically dries up during this phase, indicating a lack of selling pressure. The pattern is confirmed when the price breaks out above the upper boundary of the flag. To trade a bullish flag, a trader would look for a clear entry point upon the breakout. A common strategy is to place a buy order slightly above the upper trend line of the flag. This ensures that the trade is entered only after the breakout is confirmed. The protective stop-loss order is placed just below the lower trend line of the flag. This placement minimizes potential losses if the pattern fails and the price reverses. The profit target is often calculated by measuring the height of the flagpole and adding that distance to the breakout point. This method provides a logical and objective way to set a target, offering a favorable risk-to-reward ratio for the trade. The bearish flag is the mirror image of its bullish counterpart and signals the continuation of a downtrend. It forms after a sharp, swift decline in price, which constitutes the flagpole. This drop is usually fueled by negative news, poor corporate performance, or broad market weakness. After the steep fall, the price enters a brief consolidation phase, forming the flag. This flag is a small rectangular pattern that slopes upward against the primary downtrend. This slight upward drift is a bear market rally, or a so-called dead cat bounce. It represents short sellers covering their positions, but there is insufficient buying power to trigger a genuine reversal. Volume typically diminishes during this consolidation. When trading a bearish flag, the strategy is reversed. A trader would look to enter a short position when the price breaks down below the lower trend line of the flag. The entry order, a sell short order, would be placed just beneath this support level. The stop-loss order should be positioned just above the upper trend line of the flag to protect against a sudden reversal or a failed pattern. The profit target is calculated by measuring the length of the flagpole and subtracting that value from the breakdown point. This provides a clear objective for the trade and helps in managing the position effectively as the price continues its downward trajectory. The formation of a flag pattern is a direct reflection of the collective psychology of market participants. It tells a story of momentum, exhaustion, and resumption. The flagpole is born from a sudden and strong imbalance between buyers and sellers. In a bull flag, a wave of aggressive buying, fueled by FOMO or fear of missing out, drives prices sharply higher. Early believers and institutional players jump in, creating a powerful uptrend. This rapid ascent leaves many would-be buyers behind, waiting for a better entry point. The high volume during this phase confirms the strength and conviction behind the move, setting the stage for the next phase of the pattern. The flag itself represents a necessary pause, a period of psychological consolidation. After the frantic buying of the flagpole, the initial momentum wanes. Early buyers, now sitting on significant profits, begin to sell portions of their holdings to lock in gains. This selling pressure is met by a new group of participants, the latecomers who missed the initial rally and are now eager to buy on any dip. This creates a temporary equilibrium where neither bulls nor bears have full control. The downward slope of the bull flag shows that the profit takers have a slight edge, but the low volume indicates their selling is not aggressive enough to reverse the strong underlying trend. This battle of wills creates the tight, orderly channel of the flag. The bulls who believe the trend will continue are buying the dips, establishing a support level. The bears and profit takers are selling the small rallies, creating a resistance level. This tug of war continues until one side gives in. As the consolidation progresses, the remaining sellers become exhausted. The low volume signifies that the selling pressure has dried up. At the same time, more buyers are becoming convinced that the uptrend is real and are waiting on the sidelines. This sets up a coiled spring effect, where energy is being stored for the next directional move. The breakout is the psychological tipping point. A catalyst, whether it's a piece of news or simply the exhaustion of sellers, pushes the price above the flag's resistance. This breakout is a clear signal that the bulls have won the battle. Seeing the price move higher, the sideline buyers rush in, creating a surge in volume and propelling the price upward with renewed force. The traders who were shorting the consolidation are forced to cover their positions, adding more fuel to the rally. This cascade of buying activity is what drives the price toward the target projected by the flagpole, completing the psychological narrative of the flag pattern. So, a robust trading strategy for flag patterns really requires a clear, step-by-step process. The goal here is to maximize the probability of success while, strictly managing risk. The first step is identification. You must correctly identify a valid flag pattern. This means looking for a strong flagpole with high volume, followed by a tight, orderly flag consolidation on lower volume. The flag should slope against the primary trend. It's important to avoid patterns with weak flagpoles or very long, sloppy consolidation phases. Patience is key. Wait for a textbook setup rather than forcing a trade on a subpar pattern. This disciplined approach is honestly the foundation of a successful strategy. The second step involves defining your entry point. The most common and relatively safe entry is on the breakout. For a bull flag, you would place a buy stop order just a few ticks above the upper trend line of the flag. For a bear flag, a sell stop order would be placed just below the lower trend line. This method ensures you only enter the trade after the market has confirmed the direction. An alternative, more aggressive entry is to buy near the lower support line of a bull flag or sell near the upper resistance line of a bear flag. This offers a better entry price but carries a higher risk of the pattern failing before a breakout occurs. The third and most critical step is risk management. Before entering any trade, you must know where you will exit if you are wrong. For a bull flag trade, the stop loss should be placed just below the lowest point of the flag consolidation. This is the logical point of invalidation for the pattern. If the price breaks below this level, the bullish thesis is no longer valid. For a bear flag, the stop loss should be placed just above the highest point of the flag. Using a predetermined stop loss is, non-negotiable. It protects your capital from significant losses and removes emotion from the decision-making process when a trade goes against you. The final step is setting the profit target. A standard method for projecting the target is the measured move technique. Measure the price distance of the flagpole from its base to its peak. Then, add that distance to the breakout point of the flag. For a bull flag, you add the flagpole's height to the low of the flag to project the target price. For a bear flag, you subtract the flagpole's height from the high of the flag. It is wise to take partial profits as the price approaches the target. This allows you to lock in some gains while leaving a portion of the position to capture any further upside, perhaps using a trailing stop. To understand flag patterns better, let's, analyze real examples from the Indian stock market. Consider the chart of Reliance Industries Limited from early 2024. The stock experienced a sharp rally, moving from 2,400 rupees to 2,700 rupees in just over a week. This strong upward move on high volume formed a clear flagpole. Following this rally, the price entered a consolidation phase for approximately 2 weeks. It drifted sideways and slightly down, forming a rectangular flag between 2,650 and 2,700 rupees. The volume during this period noticeably decreased, signaling, a healthy pause. This setup presented a classic bullish flag pattern for traders to watch closely. The trading opportunity materialized when the price broke out of the flag. The upper trend line of the flag was around 2,700 rupees. A trader could have placed a buy order at 2,705 rupees. The stop loss would be placed just below the low of the flag, which was at 2,650 rupees. This defined a risk of 55 rupees per share. The flagpole's height was 300 rupees, from 2,400 to 2,700. Adding this height to the breakout point, or the flag's low for a more conservative target, suggested a target price around 2,950 to 3,000 rupees. In the weeks that followed the breakout, Reliance Industries rallied strongly, comfortably exceeding the 2,950 target and validating the pattern's predictive power. Now let's look at a bearish example with Infosys. During a period of market weakness in 2023, Infosys saw its price drop sharply from 1,500 rupees to 1,350 rupees. This steep decline served as the flagpole of a potential bear flag. After hitting the low, the stock staged a weak rally, consolidating in an upward-sloping channel for about 10 days, moving between 1,360 and 1,400 rupees. This counter-trend rally occurred on diminishing volume, which is a classic sign of a bear flag. The upward drift showed a lack of genuine buying interest, mostly just short covering and minor bargain hunting before the next leg down. The trade was triggered when the price broke down below the lower trend line of the flag, which was around 1,360 rupees. A short seller could have entered a trade at 1,355 rupees. The stop loss would be placed just above the high of the flag at approximately 1,405 rupees, limiting the risk to 50 rupees per share. The flagpole's height was 150 rupees, from 1,500 to 1,350. Subtracting this from the breakdown point projected a target price around 1,200 rupees. Following the breakdown, Infosys continued its decline over the next month, eventually reaching the 1,210 level, providing a highly profitable trade for those who correctly identified and acted upon the bearish flag pattern. While flags are powerful continuation patterns, they have a close cousin in the world of technical analysis, the pennant. Both flags and pennants are short-term continuation patterns that appear after a strong directional move. Both signal a brief pause before the original trend resumes. They share the same core components, a flagpole representing the initial sharp move and a consolidation phase. The key difference between them lies entirely in the shape of this consolidation. Understanding this distinction is, crucial for accurate chart interpretation and for setting the correct entry and exit points for a trade. A flag pattern, as we have discussed, has a consolidation phase that takes the shape of a rectangle or a parallelogram. Its boundary lines, the upper resistance and lower support, are parallel to each other. This parallel structure gives it the appearance of a flag flying from a flagpole. The consolidation drifts gently against the primary trend. For instance, a bull flag slopes down and a bear flag slopes up. This rectangular shape signifies a very orderly and structured pause, with buyers and sellers operating within a well-defined price channel before the trend continues its journey. In contrast, a pennant pattern features a consolidation phase where the boundary lines converge. Instead of being parallel, the upper resistance line slopes downward, and the lower support line slopes upward, forming a small symmetrical triangle. This gives the pattern the appearance of a small triangular flag or a pennant. The converging trend lines indicate that volatility is contracting and the price range is tightening. This coiling of price action often leads to an even more explosive breakout when it occurs. The psychology is similar to a flag, a pause in the trend, but the converging nature of the pennant suggests a more rapid buildup of pressure. From a trading perspective, both patterns are handled in a very similar way. The entry is taken on a breakout from the consolidation pattern, above the upper trend line for a bull pennant or below the lower trend line for a bear pennant. The stop loss is placed on the opposite side of the pattern. The profit target for both is typically calculated by measuring the height of the flagpole and projecting it from the breakout point. The main takeaway is that while their shapes differ slightly, their implication is the same. The trend is pausing, not reversing. Recognizing both can double the number of high-probability continuation trades you can identify. To improve the reliability of your flag pattern trades, it is, essential to use a checklist. This systematic approach helps you avoid subpar setups and focus only on high-probability opportunities. It ensures that you are not just seeing what you want to see, but are objectively verifying the key characteristics of a valid pattern. Before placing any trade based on a flag, run through these checkpoints. If a potential pattern fails to meet most of these criteria, it is often wise to just stay on the sidelines and wait for a better setup to emerge. A disciplined process is what separates consistently profitable traders from the rest. Here is a simple checklist for a bullish flag pattern. A strong flagpole. Is there a sharp near vertical price advance? A move of at least 20 to 30% or more is a good starting point. High volume on flagpole. Did the initial rally occur on significantly higher than average volume? This confirms institutional participation. Orderly flag consolidation. Does the consolidation form a neat downward sloping rectangle or channel? Avoid wide, choppy, or V-shaped pullbacks. Low volume in flag. Has the volume decreased substantially during the consolidation phase? This shows a lack of selling pressure. Duration. Is the flag relatively short, typically lasting no more than 3 to 4 weeks on a daily chart? Longer consolidations weaken the pattern. Breakout confirmation. Does the price close decisively above the upper trend line of the flag? Volume on breakout. Is the breakout accompanied by a surge in volume? This confirms the resumption of the uptrend. For a bearish flag pattern, the checklist is simply the inverse. A strong flagpole. Is there a sharp, steep price decline? High volume on flagpole. Did the initial drop occur on high volume, indicating a strong selling? Orderly flag consolidation. Does the consolidation form a neat upward sloping channel? This is a weak bear market rally. Low volume. Has the volume dried up during the upward trend? This signals a lack of buying. Duration. Is the consolidation brief? Breakdown confirmation. Does the price close firmly below the lower trend line? Volume on breakdown. Is the breakdown supported by an increase in volume, confirming the downtrend's continuation? By methodically applying this checklist, you force yourself to analyze the pattern's structure, volume, and context. This reduces impulsive trading decisions and increases the odds of entering trends that are backed by solid technical analysis. Think of this checklist not as a machine, but as a quality control mechanism for your trading business. It is a simple yet powerful tool that focus on the most promising trading signals that the market provides. Over time, this disciplined approach will build both your confidence and your trading account. While flag patterns are reliable, traders often make common mistakes that can lead to losses. One of the most frequent errors is misidentifying the flagpole. A weak, gradual price move is not a flagpole. A true flagpole is a powerful, explosive move that establishes clear momentum. Trading a flag pattern without a strong flagpole is like trying to sail a boat without wind. The setup lacks the necessary force to carry the price to its target. Always ensure the initial move is sharp and decisive before you even begin to look for the subsequent flag consolidation. Another major pitfall is ignoring volume. Volume is a critical confirmation tool. A flagpole should form on high volume, and the flag consolidation should form on low volume. The breakout or breakdown must occur on a spike in volume. Many traders focus only on the price pattern and neglect the volume story. A breakout on low volume is often a head fake or a false signal. It suggests a lack of conviction behind the move and increases the probability of the pattern failing. Always wait for volume to confirm your analysis. It is, honestly, the engine that drives the price. A third common mistake is entering the trade too early. Eager to catch the move, Some traders will enter while the flag is still forming, before a confirmed breakout has occurred. This is essentially guessing. The pattern is not complete until the price closes outside the consolidation channel. Entering early exposes you to the risk that the pattern fails and the price reverses from within the channel. Patience is a virtue in trading. Wait for the market to give you a clear signal, the breakout, before you commit your capital. This confirmation significantly improves your odds of success. Finally, poor risk management can turn a good setup into a bad trade. Failing to set a stop loss or setting it too wide exposes you to unacceptable losses. Conversely, setting a stop loss too tight can get you stopped out by normal market volatility before the real move begins. The logical place for a stop is just outside the opposite boundary of the flag. Additionally, failing to have a profit target can lead to giving back hard-earned gains. Use the flagpole measurement as a guide to take at least partial profits. By avoiding these common errors and sticking to best practices, you can trade flag patterns with greater confidence and consistency.